Welcome to CSI Chat, where every topic's fair game. From finance to mysteries, we'll never be the same. Our hosts an accountant with a knack for a joke. We'll dive into the details and laugh until we choke. CSI Chat, where the numbers beat the fun. We'll explore every subject under the sun.
Okay, well, we are really lucky today to be joined by Jake Ryan, and we're going to be spending the next 60 to 90 minutes talking about cryptocurrency. And there's no better person to talk crypto than Jake Ryan, and I'm going to tell you why. So I'm going to give a little bit of background on Jake. Jake is the chief investment officer at Tradecraft Capital, which is a crypto asset hedge fund. He is an advisor to several venture-backed startups and was with two VC accelerators at a private equity firm. And he's also the author of two terrific books. One of them is called Crypto, Investing in the Age of Autonomy, and Crypto Decrypted. Now, I've actually read both of these books, and I would highly recommend that people take a read. For myself, I'm certainly on the lower end of the crypto knowledge scale. And Jake has drafted or written both of those books specifically for, definitely for people like me. And again, he certainly gets into advanced topics as well. So it's not just for people on the beginner side of scale, the scale, but definitely for beginners out there. And I know there's a lot of you. I would, if you're looking for a book to kind of take your crypto knowledge up, definitely take a read of Jake's book. It's terrific. And Jake, well, thank you, very much for joining us. We really appreciate you taking the time.
Yeah, thanks, Scott. Glad to be here.
Now, I just wanted to give a couple of thoughts on crypto asset investing in the age of autonomy, because before I opened up this book, I did not expect to be fascinated by, learning about the history of currencies and, whether it's gold or the pros and cons of, several currencies that existed in the past. And in the book, the way you go into this and talking about currency policy, you kind of get a much better understanding of what crypto is, because, people might have hesitations about cryptocurrency, but, when you think about what actually is a US dollar or what is a Canadian dollar, it's hard to answer that question too. And why do those have value? Why do those elements have value, and could that value change? And when you start actually trying to answer those questions, you start to realize why crypto or why anything would have value. And I found it really, really interesting. And a couple chapters on that. I didn't expect to be fascinated with this background of currency, but it really opens up your eyes to all the different currencies that are out there and what actually makes a currency valuable. And it kind of, in my mind, it kind of, this fear factor of crypto, as for a lot of beginners, when they hear crypto, I know I do, you start to get a little bit concerned and you start to get fearful that this is this is something that you don't understand. But once you actually start reading a couple chapters of your book, that fear comes down really, really quickly. And you start to get a much better understanding of what crypto actually is. And how it kind of relates to, whether it be the US dollar or the Canadian dollar. Now, was that kind of the intent of those early chapters, Jake?
Yeah, I think just to set kind of the stage, we have been here before, where time and time again, we've started out with sound money policy, and we've had money that has been backed by some sort of resource or scarce asset. For most of the past history, past few millennia, it's ended up being gold or silver or some type of precious metal. And there are reasons for that. But a government will start with sound money policy. Eventually, they will come in and debase the currency. In the early days, like in Greece and Rome, literally debase, meaning to change the amount of gold or precious metal that was in each coin, and they would have less and less gold, or silver or rare precious metals within their coins, and debase the currency that way. And so you would have gold coins from different countries with different amounts of gold in them. And what people would want to do was hoard the good gold coins and sell or use in the economy the coins that, were being debased. And like in Rome's example, they took their precious metals down to something like 98%
Wow.
over a couple hundred years. Uh, and that's, how they funded wars. And then we got into later times where I think it was probably France that started with bills, France and England and the Netherlands that started with paper bills that you could use in exchange with the banks and get gold coins. But it was easier to travel with, and there'd be various reasons that the government would want to be a proponent of the paper bills, and then inevitably they would change, how much you could trade for it, or create inflation within there, and set us off into what we call unsound money policy, right? And this has happened time and time again. I think I gave 6 or 7 examples of various countries in the past that had done it. And we're here again, where we started out with sound money policy. We had sound money effectively through 1972. But when Nixon did take us off the gold standard or have a true backing of a US dollar, with a precious metal, silver or gold, we were brought into the world of fiat currency, which is just by declaration, value by declaration. And that allows governments to have this deficit spending. It allows them to print money, and it creates a monetary cycle and a economic cycle, with the economic cycle really being driven by the monetary cycle. So if you print more and more money, you're debasing the currency. It's worth less. And we have asset price inflation, where it looks like the value of assets are going up, but really it's going up in nominal terms, but we're debasing the currency. So then we have this problem, and we're continuing to do it these days. So
And this is one of the areas I found really interesting is this whole linkage to gold. And like you say, when or some other precious metal, is that back in the early days, they actually used to form part of the currency. Like you were saying, and then and then they started using less and less of it, and then they transitioned to dollars, and then in the early 70s, there's a big change. Why was that important to link currency to a precious metal at that point? Like, what was the significance of doing that?
yeah, I think what we found over the millennia were good money has 6 properties, right? It's divisible, it's acceptable, it's scarce, it's a unit of account, and if these 6 properties form really what's good money, and so we might have started out with cows or something like that
Yeah.
might have had scarcity, and it had acceptability. People would accept it, but it didn't have durability, right? Which is
Yeah.
one of the forms.
Yeah.
Or we would have stones, and they might have been, they didn't have a unit of account, like they weren't all exactly precise. Whereas gold, you can get everything to the exact same size. And so it's these 6 principles of good money that drive what really is good for just the abstraction of money, the exchange of value over time. Gold ended up being better than barrels of oil or stones or cows. One thing that we don't have in our money today is the scarcity, right? And that's one thing that something like Bitcoin brings back to money. There's only 21 million Bitcoin that will ever be mined. And currently in our money today, we don't have the concept of scarcity, right? The Fed or central banks around the world can print, expand the Fed's balance sheet and print more or reduce. But there really isn't that notion of scarcity like there was in past money. And that's a really important factor. And that's why things like gold and Bitcoin are doing well today, because they introduced that sixth property, that scarcity property that we're not seeing in money. And if we're printing on average, 7 or 8% more monetary units around the world, we're debasing our currencies by that every year. And so that's really where the problem is.
And I think the book was written in 2021, and you had laid out a lot of the issues surrounding the US dollar at that point. And it would seem like a lot of what you had predicted actually came true. Is that there's continued to be issues. Obviously, we're in the news today. There's tax bills, there's tariffs, there's a whole bunch of issues where it would appear that they're trying to the deficit is obviously a big issue. And so when you look at it today, do you think that those issues you outline in your book in 2021 with respect to the US dollar are 10x, 20x more prevalent than they were back in the day? Or do you think that, maybe with all of this, you'll be able to turn the corner?
Yeah, let's see. So I wrote the first long form article on Medium. It was Medium or Hacker Noon in 2018. That was a 3,500 word version of the book, but it was investing in the age of autonomy. And then the book I wrote in 2020. And I think for the most part, we're locked in a situation that is almost impossible to get out of. And it's because the political expediency of printing is so much easier than either of the other two options, which is austerity, which is, asking people to have massive cuts in, it would have to be in things like Medicare and Medicaid and Social Security here in the United States. So some sort of fiscal austerity, and then, being able to not only not have deficits anymore, but start to really having some sort of payback plan.
Yep.
And really, we're doing the opposite. Every year, the growth of the deficit is a little bit more. So in 2020, on average, we were putting about $1 trillion a year here in the United States onto our debt. And we're talking about the potential of this year being something like 2 or 2.5 trillion with this big, beautiful bill. And so, and then COVID, that was between $1 trillion and $1 trillion, between 1 and 2 trillion for those years of adding to the deficit. So back then, I think we're at something like 28 trillion in debt, and now we're at something like 37 trillion. So the rate of change is accelerating. I think I said in my book, I would suspect that the US dollar as the world reserve currency would be in jeopardy if our debt hit $100 trillion. So we're at 37 trillion now, but it would really only take 8 or 9 years to get to that 100 trillion with the current rate of growth. So that puts us to something like 2033 or 2034, when I think we would really be in trouble with the US dollar's hegemony, with it really being the single reserve currency. And we're seeing it break, even today. We have, 2 other currencies at least, some led by China, some led by Russia and Iran and South American countries, where they want to back their currency with some sort of resource. So we're seeing that being tackled even today.
And where you mentioned 7 or 8 years, many of us, and I'm sure you are as well, are familiar with happened in Argentina. They normally like to point to Argentina as saying, well, the country could default on its debt effectively, and that would cause a whole bunch of problems. And do you think that that's kind of how this would play out? Is that 7 or 8 years, you get to 100 trillion, God only knows what the interest is on that each year, which is just it just multiplies. Is that, a kind of a similar situation to Argentina playing out? Is that kind of where you'd see it going?
I don't think so, because we're the world's reserve currency. We never have to default on it. We can always print more money and pay for it, right?
Yeah.
The problem is are we paying it with the purchasing power, the same purchasing power? And that's really what's going to happen,
Yeah.
right? So we'll never we never need to default on our debt. We can always print more money and then pay it, but then we're always in that cycle of debasement, losing purchasing power in the dollar. And then at what point do we lose trust? We used to have, like, Japan and China were, top 5 buyers in US treasuries back in the 90s and the 2000s. But as of about 2010, they've been basically net sellers over the last decade or 15 years. Obviously Russia isn't going to be buying any treasuries. So we're losing a lot of sovereign wealth funds or governments that would be buyers of our treasuries. And more, it's like hedge funds.
Yeah.
And, those different types of buyers can bring different types of behavior. With governments, they're planned to keep those treasuries, and it's, a part of the trade balance. And, they're using that to offset, for example, with China, they're selling us a lot of goods, getting cash or treasuries, and just holding that. Whereas, hedge funds are much more duration dependent. They're not looking to hold things for years. They might be using leverage. And so the whole money market system can be much more fragile with that type of owner. And so we're seeing that fragility today. We see that at least a couple times a year. We'll see breakage. I think it was last year we saw, with a Signature Bank and Silicon Valley, and
Yep.
there were 3 banks that went under, and a lot of that had to do with having treasuries that went down in value, and were affecting their balance sheets, and we're pulling those banks under. And so, or in 2020 we saw huge volatility in the bond markets that were taking, everybody was in this forced selling vicious cycle. So we see this fragility affect our markets time and time again.
And the other thing that was really striking about your book is this concept of, well, if it's sitting in a bank, that means, it's never going to go away. Like, it's always going to be there. You mentioned Silicon Valley Bank. Up until the US government kind of effectively bailed them out, they were holding billions and billions of dollars of cash, that it was possible that the entities, the counterparties who actually own that cash, weren't going to get that cash. And, and that's pretty scary, and you talk the same thing in your book about even this concept of owning a security in a company, is that a lot of these securities you actually hold at brokerages. You're not sitting at home with a share certificate under your mattress, is that these are sitting at brokerages. And to the extent that one of those brokerages were to go under and the US government were to step away from them, that could be very problematic. And it just kind of gets you to rethink your mind in terms of what's really risky out there.
Right.
When you mentioned trust, is that a fair representation, Jake, in terms of the message you were trying to deliver in your book?
Yeah, I think the number one risk really is counterparty risk. And this is one thing that tries to get settled with crypto assets. And it's the idea of ownership and possession, possession being 9/10 the law. It's probably even more than that. We always think, because in the old days, you would get stock certificates, or you would, and maybe the broker would hold those for you and be some sort of custodian. But these days, that's not really how the mechanics work. All those securities go onto that broker's balance sheet, and they have an IOU to you. You don't really have those securities that you see under your account. It's not like those are walled off and they're a custodian on your behalf. And so, for example, what were they, out of New Jersey in 2010?
We had Lehman Brothers. Lehman Brothers would have been one of them. There would have been, I guess, maybe if we're referring to the financial crisis, there certainly would have been a number of big banks that, had
certainly
had
all those. There was one that went under in 2010 or so, and they were a commodities
I see.
commodities fund, and all of those account holders who thought they were holding, commodities and futures in their accounts. They got nothing for that. And so more and more, we do have to be careful about, how we hold our assets and, do you really own those and hold those or not? We have this idea in crypto, not your keys, not your coins. And so if you're holding, Bitcoin or something else at a brokerage or something like that, that is not the same as holding the crypto assets yourself with your own keys.
Got it.
That's the one way to really combat this counterparty risk. And we saw that even in crypto a couple of years ago with FTX. When FTX went down, all the people who thought they had Bitcoin and various crypto assets within FTX, when that went down, it wasn't the same as holding the keys of your crypto assets.
Yeah, and yeah, again, you make a good point in your book too about, FTX goes down, that it's not necessarily it's not a crypto issue. It's a financial institution issue, and there's been other
Right.
financial institutions that if you are poorly managed in terms of you haven't managed your risk properly, like you talk, Silicon Valley Bank, that buy perhaps a bunch of treasuries that have lengthy, maturities and fixed interest rates, and on the other side of your balance sheet, you've got something different. That's going to be a problem, or it could be a problem. Presumably, again, with FTX, it's not necessarily a crypto issue.
Right.
Just another example of a company that frankly wasn't managed very well.
That's right. And that's one of the promises of crypto assets, is to be able to have economic transactions and that be under a trustless environment or trust minimized environment. One of the problems with any economic transactions in the past is we always had to trust a third, a counterparty or a third party. It could be a credit card company or a bank to settle all of those transactions. And with blockchain and with crypto assets, we no longer need that trusted third party. We can have actual peer-to-peer transactions, and that is the revolution. That is the aha moment. That was the top 10 computer science problem that got solved, which allows this peer-to-peer without a trusted third party to be able to settle transactions.
So then maybe give us a little bit of a primer on Bitcoin, Jake. They talk about the famous white paper, and if you didn't actually open it, you might think this is like some 500-page document, but in reality, it's like it might be just north of 10 pages. I'm not even
Right.
sure if the core is 10 pages long if you're excluding appendices and things like that. This is a very short. No, it's not that easy to read. Especially again, at least I found it. That it takes, you have to read it a couple times in order to kind of understand what they're getting at. But give us some perspective on kind of what birthed Bitcoin. Like what was the moment, and why did it start with how did Bitcoin come to be?
Yeah. Well, it was built on several past technologies that had various levels of success. The concept of digital cash, but effectively you have public financial infrastructure built, this decentralized digital electronic cash system. And what it has done that no system really had done in the past is to be able to have these peer-to-peer transactions without a trusted third party. So that's what the blockchain technology allows to happen. It solves this, what's called the Byzantine generals problem. And that problem is, if you have 10 generals trying to circle a city and you need them all to attack at once to be successful, and if they can't attack all at once, then they won't be successful. How do they pass messages around and know that they could trust those messages, know that they came from generals? How do you have that messaging? And that's effectively what the problem that gets solved. So Bitcoin was kind of the first time to use cryptography to create this mining system, this system that basically allows you to aggregate many servers that will process the transactions and also allow the mining to happen. Mining of Bitcoin happens roughly every 10 minutes, and a certain amount of Bitcoin gets mined or allowed into the circulation every 10 minutes. And so it's the entire system. And there's a lot of things that you can do with Bitcoin. You can sign messages. You could start an entire government really under the Bitcoin system, just because you have signatures, who signed what. But it was really the first system to have this pure 21 million units, up to 8 decimals deep, so you can get real precision. And it was the first one that really took off. And so, that's why it will probably be the only crypto asset that really is money. There's plenty of other crypto assets that do a lot of other things, but we don't really hear about those as much yet. And so in the coming, weeks, months, and years, I think that will be more the focus. But Bitcoin today is really having its primary driving and really being the acceptance. That's what's getting driven today. So,
And and part of the mystery with Bitcoin is its founder, Satoshi. Like, why do you think no one's ever? I guess people maybe have claimed to be him, but it's interesting that the creator of this incredible idea and this technology has really chosen to kind of stay in the shadows, and that they, which I don't know if that's helpful or hurtful to crypto. It might be more of a net negative, the fact that no one's really come forward and they could kind of, actually pinpoint it. But why do you think, why do you think that the person who actually created all this has never, we don't even know who he is? Or
yeah,
she is, I should say. I shouldn't even be saying he or she. We don't know if it's male or female, or if it's even a person, or
right.
a group of
It was
people, perhaps.
probably a group. It was probably a group of a couple, 2 or 3, but we don't know. I think that has ultimately been a net positive, and really why Bitcoin is kind of this, virgin birth, that, unique thing that will hardly ever happen again. And I think it's part of that is there's nobody to go after, in those early days.
Yep.
If there was, somebody to go after, there might've been legal cases that would take it down. That certainly happened with like digital cash and some of the precursors to Bitcoin. And so I think part of the genius is that there wasn't an owner. There was just this perpetual software running on servers all around the world, and no real organization or body or person to go after. I think that ultimately was beneficial in those early days. But that does certainly add to the unique part of the story, right? The origin story of Bitcoin. It's certainly unique.
So maybe just talk a little bit about some of the elements of this, of Bitcoin. Is, I guess, number one, is it really anonymous? Like, do you know who owns there's a view out there that, Bitcoin is used by criminals and terrorists and this and that, because nobody knows actually who owns any of this stuff or can trace it. But that's not really true. That's, I don't think that's factual. Maybe give us some perspective on, like, what personal information is required in order to complete a Bitcoin transaction.
Yeah. So Bitcoin is not anonymous, it's pseudonymous, right? And so one thing, when you do a credit card transaction, you have to give your name, the credit card account number, and just with your name and account, people can get a lot more information about you, or you have to send a lot more information than maybe should be necessary for an economic transaction. With Bitcoin, it's pseudonymous, so you don't exactly know who necessarily owns a particular Bitcoin. You can get ideas of maybe which addresses might be with bank or with exchanges, or maybe with large account holders, right? You can, there's all kinds of chain analysis and all kinds of people who can do analysis on blockchain records and come up with a lot of information. For the most part, generally speaking, exchanges and any of the infrastructure today, Bitcoin is bought and sold on accounts that have done some form of KYC, know your customer, and AML, anti-money laundering laws. So for example, if I open up an account with, Coinbase, they do the KYC AML. And so they know I'm not a terrorist. And so I'm able to do buy and sell transactions with that account. But you can also have an address, a Bitcoin address, and you can take cash. There are a couple of sites that allow, they try to get buyers and sellers of Bitcoin who might just want to do it through cash. So it's still possible to not necessarily, to have a KYC ML done on a transaction. But for the most part, most transactions, 99 plus are done with accounts that are under some sort of, banking practice.
Got it.
So it's pseudonymous, but not anonymous.
Eh,
We do need to keep some sort of anonymity within our economic transactions, at least at some level, because that's a part of free speech.
Yeah.
We wouldn't want to have a cloud where everybody knew everything in terms of transactions. You still want to be able to have a $20 bill and be able to do transactions without being able to have computers analyze exactly who that to, for everything.
And what does it mean to have a decentralized ledger? Like that's another thing that would seem to be unique with Bitcoin is this concept of a decentralized ledger. Maybe try and explain that in layman's terms, Jake. What does that mean?
Yeah. And so this is just like a bank ledger, like your checking account might be, but it's distributed, meaning every single computer that is a Bitcoin server has a copy of that ledger. And so there is no single point of failure, right? If one or, if half of the servers went down within the Bitcoin network, it wouldn't matter because that ledger is decentralized and copied all around the world. And part of that syncing mechanism of having all of those be up to date is a part of the magic of the Bitcoin system. Anytime you have a centralized ledger, right, you're going to have a single point of failure where if something went to that server or that particular ledger, it would be compromised. And so that's really a key benefit of being able to have all these copies and them all be in sync. There's no way to take the network down by taking even half the nodes down. You wouldn't be able to take the whole system down.
And the other element that you had talked about earlier is, again, one of the issues with the US currency and any currency, even the Canadian dollar, whichever one you want to talk about, is that you can always print more money. And in some cases it could be sizable amounts of incremental money that you're adding to the pool. But in the case of Bitcoin, that's not true. Is that the Bitcoin, like you say, is capped at 21 million. And maybe just talk a little bit about, that 21 million and how the mining process kind of works in terms of issuing new currency every year,
Yeah.
and how that eventually would be capped at some point.
That's right. So with centralized banks or with fiat currency, they could print trillions of dollars with just one stroke of the keyboard, right? There's no longer any connection between scarcity or resources and the money. Whereas Bitcoin, its entire consensus mechanism, this is how you know what transactions happened. The consensus mechanism is called proof of work. And so what happens is Bitcoin miners, those servers all around the world, do work. They're trying to solve a computer problem. It could be simple, like, from 1 to 100, guess what number I'm thinking? 1, no. 2, no. 3, no. Right? Until one computer finally solves the problem. And then they get the award, the Bitcoin award. So they'll get the, 6.5 Bitcoin for that 10 minutes or whatever. They'll get the Bitcoin reward, and then the miners will keep going. The entire system is working to have the problem hard enough so that Bitcoin get mined every 10 minutes. So if there are more and more servers that get added into the system, then we need to make the problem a little bit harder. And then if servers come offline the system, we make the problem a little bit easier. And that's how we get roughly every 10 minutes that Bitcoin are mined. And so you're forcing these computers to do work, and it's substantial work. I mean, to date, it would probably cost something in the realm of $80,000 to mine a Bitcoin right now. So that's a substantial amount of compute that has
Absolutely.
to happen to mine those Bitcoin. And it just goes up or down depending on how many servers are trying to compete for that. But that also gives the check and balance of you're forced to do work. Somebody is forced to take a risk to mine or create those Bitcoin. And so they have some sort of initial value because of the work spent. It's not the same as just hitting a key stroke and printing 2 trillion of them, right? There's a lot of work that had to be done. There's a lot of resources that had to be spent. And we can prove how many resources were spent to mine that Bitcoin. And so that's what gives the integrity of the system. That's how scarcity and how it's tied to resources. That's really the crux of why Bitcoin is so much different than, the Fed just printing $2 trillion by a keystroke.
Well, if they got close to the 21 million Bitcoin, do you think that they would go and say, you know what, let's increase the increase the pool to make it larger at some point? Or do you think it would always stay at 21 million no matter what, even if because at some point, presumably the mining will stop, now that might be some point in the future, or the mining is going to take so much compute. And, the coins that are available, again, you'd have to, 80,000 now, maybe that's 600,000 or 700,000 at some point in the future in order to mine that one Bitcoin. But do you see it maybe at some point they would actually increase the total pool, or is that just not even on the table?
It would be really hard to do so because they would have to change the software and then get everybody to agree to it. But if everybody agreed to it, they'd be destroying any value of the past. So it'd be extremely, I'm not saying it's completely impossible, but it'd be almost impossible to change the amount. It's already in the software, and the software is already running. And what happens is they cut the mining reward a half every 4 years, right? And so in the early days, they were minting a lot of Bitcoin. And then we've had 4 halving cycles where we've cut it from 25 to 12 and a half, from 12 and a half to 6.75, from 6.5 to 3.5 or whatever it is. So we've done that 4 times now. And so that's where you get this, it'll go out to about 100 years, but those last 50 years, you're getting the very last little Bitcoin.
Yeah.
Right now in circulation, I think are about 19 or 19.5 million. So there's only a couple million more to mine over the next 80 years. We've mined most of them into existence over the first 12 years, right? And so that's already built into the software. It'd be really hard to change.
I see. Who are you mentioned the bodies that sort of decide, like when you say everybody has to agree if there was a change, like who is there kind of an authority that sort of manages the software or anything like that? Or like who is everyone, I guess, who would make decisions on Bitcoin?
Yeah. So there would be 2 main bodies to start with. One is there is a Bitcoin core developer, and those are, 20 to 80 developers that have access to how to upgrade Bitcoin core. And so that's a diversified group in and of itself. But they have the keys and what it would take to upgrade. And then you have all of the miners which choose to run the software or not, right? So Bitcoin might get upgraded, and then miners over time will upgrade their mining software, and run on their servers. And so it's those 2 groups that would first initiate kind of decision-making, developers, but they'd want to make sure that the miners were going to accept the software. And then the users, people who have accounts, have Bitcoin, are running their own nodes. They have kind of that tertiary power, but nobody's going to, there's already $1 or $2 trillion worth of value within Bitcoin. I think it's 2 trillion now. people aren't going to want decisions made that are going to destroy that value. And so that's kind of the onus.
Yeah, because the thing is right now, like you say, the Fed can print out more money, and we don't really have a say in that. You know what I mean?
Right.
And how do we even see it? I guess we see it through inflation. Is how we kind of see that if they're going to just increase the amount of money, like you just don't have much. It's
Yeah.
it's kind of hard to unpack all of that. You know what I mean? As just a
Yeah, you
regular
can see it.
consumer.
They report it. So there's something called global M2 or the Fed's M2. It's the money supply, the second level of money supply. And they print statistics on it, the St. Louis Fed, and they'll give you those numbers. And then really following global liquidity, global M2 liquidity, there's an index for that. That's super important to follow because you want to know whether the global central banks are expanding or contracting. Bitcoin does quite well during those expansionary cycles. We did have a year and a half of quantitative tightening from 2020 to 2021, kind of that time range. And then, we had where Bitcoin went down 60, 70%, something like that. And that was during that quantitative tightening cycle where the Fed was shrinking its balance sheet. But now we're in another expansionary cycle. They start with rate cuts. I would expect more rate cuts. They have to roll about $8 trillion worth of treasuries this year, just from past treasuries, both principal and interest. They need to roll treasuries that are becoming mature. And so they're going to want to do that at the lowest rates possible. And so I would expect to see more cutting this year, though we haven't gotten any indication from the Fed. There may be some sort of, ginned up issue that happens that they allow markets to tumble for a while and they come in as the white knight and fix it by lowering rates. That's something that happened in March 12th of 2020. So I wouldn't put that, out of the realm of possibility.
So the next question, and you raise this in your book, which again is something you start to really think about when you raise the question out there, is how do you value Bitcoin? If it's trading at X thousands of dollars, how do you determine that that's a fair price to say, hey, I'm going to dispose of whichever currency I have in order to acquire Bitcoin? When it talks about a company, you can pull perhaps a DCF or something like that and apply a discount rate and take their cash flows, discount the cash flows and try and come up with a value of the company. And then again, you have some interesting tidbits in the book about, if you have this rare Star Wars action figure and someone were to sell it for $100,000, like how do you reconcile that in your head on this piece of plastic that is all of a sudden worth $100,000? So give us your 2 cents, Jake, on, how do we value Bitcoin? And if you're thinking about buying it, like what are some of the factors that you would consider to determine is the price right for me?
Yeah, I think I would come about it a few ways. The first way, and this happens with any marketable security, is you have a primary dealer in the secondary market. And for the most part, all of us are buying Bitcoin on the secondary market because we're not buying Bitcoin from miners. But miners ultimately are the ones that first get the Bitcoin, right? When they mine it and they get the mining reward. So they're kind of the primary dealers. And one thing to note is, okay, well, how much did that cost them to mine a Bitcoin? So having kind of an understanding of where the current average mining price is important. And you can get that information from, Glassnode and other blockchain metrics type companies will have information similar to that. And then you want to get into this is a network good that has network effects. And so the number of people using this is really where a lot of the value creation and accrual is happening. And so it's the idea of, if you have one fax machine, that's effectively worthless. If you get two fax machines, okay, then now there's some value. And if you can get a network of fax machines, or similar to Facebook, right? If you have one person on Facebook, it's not very valuable. But as you get two in the millions and 10 millions and 100 million and a billion, it's that network good has network effects. And there's something like Metcalfe's law that gives you this idea of the number of nodes is proportional to the square root of the nodes. And so, looking at how many people are using the network and are the number of addresses expanding or contracting goes into some of that calculus. There's something called MVRV, market value to realized value. And so there's some various ratios similar to PE, price to earnings, or PEG, price to earnings relative to growth, that might be with stock market. We have similar ratios within Bitcoin. And so I would be using a lot of those. And then fundamentally, I'd look also at, the economic cycle. We talk about these 4 seasons, spring, summer, winter, and fall. And it's good to own Bitcoin in 3 of the 4 of those seasons, but winter, the economic season of winter, which is falling growth and falling inflation, that's not a good time to own Bitcoin. And we've seen that time and time again in the 4 and 5 year cycles, where there's been 1 year that it goes down 40 to 70%. And so I'd be aware of where we were in the economic cycle, and looking to accrue Bitcoin in those 3 months. And then, depending on your time horizon, figure out what you want to do about winter. But I think all few of those give you a kind of a comprehensive way to look about it. The primary, secondary dealers, some valuation ratios, and then where you are within the economy. And the economy matters not as much for the economy, but really what are they doing in the monetary cycle, right? Are they expanding the money supply or contracting it? And for the most part, they're going to be expanding it most of the time and contracting it very little. But if the Fed came out and said, okay, we're going to be doing QT again, then I would probably be selling, a net seller.
And the people that buy Bitcoin, now again, I'm going to generalize a little bit here, so obviously this isn't going to apply to everyone, but do you think, are they buying it for a long-term investment of something that they're going to hold for the long term, to say, look, like some of these other currencies like US dollar and things, who knows what they're going to be in 10 to 20 years? Do you think, that's why a lot of people are buying them? Or do you think other people are buying them, because they're actually using it to pay for goods, and they don't, maybe the inflation on crypto is a heck of a lot lower than the inflation on, the US dollar or the Canadian dollars? Like, what do you think, what do you think the primary motivation is, or is it all over the board in terms of the reasons why people are buying cryptocurrency?
No, I think early on in Bitcoin, we thought it would be an electronic cash system, and you would be buying Starbucks and things with it. But as time went by, I think the primary utility of Bitcoin specifically is to hold value over long periods of time.
Got it.
And so for the most part, I think people will be hoarding Bitcoin and using stable coins for everyday transactions. So, they may sell a little of the Bitcoin and have stable coins. And I think most transactions that are going to be digital or digital assets based are going to be with stable coins. I think they'll be the true competitor to Visa and MasterCard. I think you'll start to see competition within the next year between stablecoins and Visa and MasterCard, or either financial institutions or Amazon coming up with their own token and being able to have all of the transactions happen with that token, and Visa and MasterCard being more and more cut out of a lot of transactions over time. So I think the cheaper, faster method of an actual digital asset is going to win over digital veneer, but really paper. I mean, Visa and MasterCard really are just paper processes that take days to settle, and digital assets are going to be cheaper and faster. So they will win that over time.
Well, and you talk in your book a lot about transaction costs. If you don't pay your Visa or MasterCard on time, the transaction costs are not just a little bit significant; they are very significant. It's frankly, it's somewhat surprising that some of the stuff's even allowed. Those interest rates that are embedded in, and I guess one of the perhaps advantages of stablecoin or Bitcoin is when you start to cut out, these different layers, is that the transaction costs drop down significantly as a result. Is that fair?
Yeah, absolutely. Yeah. I mean, we can get well under 1% when Visa and MasterCard charge roughly 3% per transaction. So yeah, I think we'll get significantly under that.
And now the next thing that is complicated, and see if you can explain this in layman's terms, Jake, is the concept of a blockchain. Is the cryptocurrencies or Bitcoin run off a blockchain? The reality is, what I had learned in the book is that there's actually a lot of different applications for a blockchain. To say that a blockchain is just something that is affiliated with cryptocurrency, I don't think that's right at all. You can use a blockchain for a bunch of different things. So again, the blockchain is a broad, really has a broad meaning. But if you were to dumb it down and try and simplify, how would you explain, the concept of a blockchain to someone like me who, perhaps is, again, lower on the scale in terms of knowledge of what that actually is?
Yeah. Well, I'd say a, a blockchain you can think of as a very specialized database. And instead of normal databases that have, you could create records, you could edit records, you could move records, you could delete records. With a blockchain, you can only create a new record. That's the only thing you can do. And what's interesting about that is, um, it has a level of permanence to it that, you can think of a blockchain. Um, every new block that gets created, it's like a layer of, um, oh, if you had like an old dinosaur and it had not mold, what is that? M- um, oh, I forgot what that's called. But think of a blockchain, just every block that happens, it's more and more solidified. There's another layer of an onion. There's another layer, and every block that gets created, that history is more and more secure. That it happened and it can't be edited. Right?
Is a Lego block maybe a similar type, like a Lego tower where you actually can't take out anything before it? Like, obviously Lego, you can pull it out, but if you had a Lego with a bunch of different colors,
Yeah, that's
where,
right.
would that be a fair
Yeah, because
representation of what a blockchain
you
is?
can't pull it out, right? And so the ones at the bottom are going to be more secure or not able to be removed unless you removed all the ones atop of it. And so, that ability to not have an editable record, by definition, is, some of the value, because you're not able, you don't have to worry about, um, a database admin coming in and edit or being able to edit any transaction. It's self-reinforcing, that the technology doesn't allow. And so that has great applications for certain areas. For example, you could use a blockchain for provenance, right? If you had some sort of title system for houses or for fine art, you could be able to, move the provenance or have the history of provenance of particular records and know that they would be accurate over time. Um, you could use them in supply chains to know, maybe where eggs came from or cows came from, and you would know, you could keep that record history and know that it wasn't edited. Um, so there are a lot of applications of blockchain technology that can happen. And most of the crypto assets that are out there aren't in the area of money. They're doing some other type of activity. We have layer one blockchains that are allowing these smart contracts. And so it's the idea of smart money, or the idea of money and contracts, legal contracts. You could think of, an invoice as being a very simple contract, but we can get very complex in the type of contracts that we could have. And this is what's going to really, propagate this age of autonomy, this idea of being able to have economic transactions without human intervention. And that's really where the book starts to go is, we have a few technologies that are coming together, IoT and sensors. They're generating massive amounts of data. And then we have AI taking that data and turning it into knowledge. Then we have robotics being able to use that knowledge in the physical realm to generate activity, economic activity. But it's blockchain technology that allows us to generate economic activity in the digital realm without human intervention. And that's where we're really going to in the coming years and decades. And it's really that's providing the edge. This age of autonomy is all about autonomous operations. And that's really what's going to drive the economy of the future, like the age of information did for the last few decades. Things like ChatGPT and other AI agents and large language models have effectively rendered knowledge, democratized knowledge. So you don't have to be a lawyer to do legal activity or a software developer to do software. You can get these AI agents to write software and do all kinds of things. And so the edge is no longer knowledge. Now it's building autonomous operations.
Yeah, like you say, you take something like healthcare. Back in the day, if you wanted to get advice on if you had a certain ailment, you have to go into a doctor and book an appointment and rely on that doctor in order to give you. Maybe you get a second opinion if you don't necessarily like what you hear. But nowadays, again, you're probably still going in to see a doctor, but man, you can do a lot to validate what that doctor is saying to you. And those language models that are out there, in some ways, are smarter than the doctors. You know what I mean? It's like you said, that age of autonomy. The way I almost think about it when you use that term is, we can do a lot of things independently now. We don't need, you talk about crypto. We don't necessarily need a bank. We can just do it all on our computer. We don't need a doctor per se. Again, you probably want to have a doctor involved, but man, you can still do a lot of work on your own in order to figure out a lot of this stuff out. Is that a fair kind of,
Yeah,
way to?
there are AI agents that are like radiologists or that can read X-rays
Crazy.
as good as doctors can. I don't think patients have direct access to them yet. But they will be more and more used throughout the healthcare system. More and more of these specialized AI agents that can do specialized health activity and, read X-rays and do all types of healthcare type functions. And yeah, I think less and less doctors will probably be needed, or we can get more and more throughput through the use of a lot of these technologies. And they're replacing a lot of work that normally a human would be able to be needed for.
And one of the questions that would come up is say, look, these blockchains and these decentralized networks, is it possible for them to get hacked? Like if a financial institution were to get hacked, that's a big problem, obviously, for that financial institution. But when you have a decentralized network where you have all of these different nodes kind of working together, what would be the process to even kind of hack one of these? I think you talk about in your book about a 51% attack, but that would seem to be not the easiest thing in the world. It's not like you just steal somebody's password and boom, you're in the system. The process is a lot more involved than that, presumably.
Oh yeah. Bitcoin has never been hacked. Ethereum and none of the big ones really have ever been hacked, meaning the blockchain hacked. Now there are some ancillary activities where if you're trying to move assets from one blockchain to another, it takes a technology called a bridge, right? And some of those have been hacked. We've had social engineering where people have been hacked or addresses have been hacked when people have lost their individual money from some type of hacking of an account or an address. But a full blockchain hasn't been hacked, right? So over the last 12 years of Bitcoin running, the Bitcoin blockchain has never been hacked. And so, that you can provide a lot of, and what's helping that is the security of all the servers and all that compute power is helping to secure that network. It would take a massive amount, of investment, hundreds of billions or trillions of dollars to take down that network, which is virtually impossible. And so as these get bigger, have more value, they're much harder to hack because the compute power it would take to do some sort of attack on them.
Yeah, like the recent issue, yeah, I think it was a couple of months ago where there was, I think, a North Korea group that effectively stole. I can't remember if it was Bitcoin or another or whatever the currency was, but that wasn't because the network was hacked. That was because they managed to get into an individual's account, bypass a bunch of security measures, and basically, steal the money out of their
Price
account.
drops.
It wasn't because the underlying network itself or the underlying blockchain was hacked.
That's
Is that
right.
fair?
Or I think maybe a few months ago, maybe 6 months ago, I'm not sure. There was a large Asian exchange that got hacked, and I think they got hacked for $1 billion. Now that they were able to recover and they were able to cover the losses, but those are the types of things that can hack. But typically the blockchains aren't being hacked. Now there have been blockchains that have been hacked in the past, but they were smaller blockchains or they didn't have near the level of investment in them.
Got it. So next is to just talk a little bit about some myths about crypto. You have some funny quotes in your book about quotes about the internet by certain individuals who said that the internet was just a fad and that it was going to go away. And actually, in the second book, I actually listened to the audiobook. It was actually funnier in the audiobook the way that some of that stuff was described. So the message there is that, just because something's new doesn't necessarily mean that it's bad. You know what I mean?
Oh, and that was from a Nobel Prize economist.
Yeah.
He's my favorite economist. But yeah, that's right. Yeah, I mean, there's all kinds of funny things that have continued to be a part of the conversation, but they slowly get peeled away as we get more and more adoption. They sound more and more silly.
So if we take one of them, for example, and say, look, why do you need crypto in a nation like the United States or Canada, where you've got a fairly, well built out financial institutions, you can go to the bank, you can get money, you can buy things with US dollars, Canadian dollars without issue. Clearly crypto, the only application for it would be, again, just playing the devil's advocate, is in perhaps a developing nation where they don't have a currency. They, let's say they want to start a business, they can't raise money in that currency. A VC in the US or wherever would never be able to, or never want to perhaps, issue, give money in a different currency. So therefore the only application for crypto is in these developing nations. So maybe just start with that one, Jake, and just say why that myth doesn't really reconcile at the end of the day.
Well, I think it's not necessarily problems that we're having now. It's problems that we can see in the not too distant future. I think one thing that Bitcoin does is allows you to capture and hold value over long periods of time. And it's really a way to fight the debasement or fight inflation. So having a portion of your assets locking in on purchasing power and effectively being an insurance policy against the government theft via inflation is important. It's a part of any financial plan. You want to have some assets that are producing, right? Like stocks, and you want to have some assets that are simply scarce, and by their scarcity, they're holding purchasing power over time. And that would be gold and Bitcoin. That's the important part, because in the not too distant future, we are going to have counterparty risk. We're going to ultimately have a problem where trust is being eroded a little bit over time. And at some point, that's going to be a problem in the US dollar. That's going to be a problem with assets being held at brokerages. Our ultimate problem is going to be some sort of counterparty risk. And so we want the tools and technology to be able to combat that effectively. And crypto assets, and Bitcoin specifically, do that. And then we also have crypto assets that are doing tons of other things. I mean, if you can think of Google Maps, right? Google went out and mapped all the globe, and they get all the economic benefit of that. there's a blockchain, I think it's called Hive Mapper, right? Where you can go and take pictures and help build out their maps, and you get paid in that currency. And then people who want to use Hive Mapper, can pay, and we can, it's the next level of business. We went from a SaaS, software as a service business, to uh, a pipeline business, and to a platform business like Uber or Airbnb, where instead of just having the supply and you're trying to go get the demand, Airbnb is the marketplace, and then they're getting the supply and demand and connecting them in real time via market. Well, there are blockchains doing that for a variety of services. I just gave you one example of Google Maps, and more of these current platform businesses will become more efficiently deployed if they're a blockchain service, where all the economic benefit can be managed through processes and through autonomous processes, and everybody can get the economic advantage either paid for or, or serviced by. That's where a lot of the next level of innovation is happening with blockchain technology.
Got it. And another myth that being honest, certainly one I would have fell victim to until I kind of read your book, is that crypto is only used by drug dealers and criminals and terrorists and things like that to go and buy missiles from wherever and ensure that they can never be identified. But and you sort of touched on this earlier. Clearly, that is not a fair representation of or not accurate at all.
Yeah, I mean, most of the hacks that have happened in Bitcoin, most people have been able to get back, half of the transactions through chain analysis and use of other entities. There was an oil company that got ransomware attack, but they were able to get, at least half of their money back. A lot of this is very easily trackable because it's all there are records for everything that happened. And, these are pseudonymous, not anonymous transactions. And more of that. I mean, really, it's less than 1%, or it's close to 1/10 or 0.2% of this being illegal activity. And there's far more illegal activity happening with $100 bills than is ever happening with crypto. It's really hard to blame the tool. It's, bad actors are going to be with anything. And I guarantee there's more bad actors with $100 bills than with Bitcoin.
100%. And the other thing that really surprised me in your book as well is the fact that some of these, securities exchanges, obviously, let's call it the SEC, they're recognizing that they better, get behind these currencies and figure out a way to get involved before it's too late. And, so what's happening is that these security commissions, like, again, let's take the SEC, are starting to support some of these cryptocurrencies. Would that be fair as well, Jake?
Yeah, I would say that they're trying now with the new administration here in the U.S., with Hester Peirce and with more pro crypto commissioners in the SEC. They're trying to provide direction for crypto and provide some sort of legal framework like Fit 21 versus this regulatory enforcement action, which was happening in the past, where they wouldn't provide any direction, but they would just go and regulate via these enforcement actions, which really weren't fair when people were really asking to have some clarity on laws. And so I think it's the change in attitude at places like the SEC, but also new regulation that's going to be coming out. If we can get some version of the Fit 21 bill to get introduced into Congress, we've gotten the Genius Act that's should be passed by next week. And more of these regulatory frameworks, that's really what's going to help drive more innovation and keep it, closer to home instead of, pushing it out to more friendly regulatory geographies.
Got it. So let's assume you have somebody listening to this, Jake, and they say, "Man, I like what Jake has to say. I want to go out and, let's say, dip my toe into crypto." How would you suggest they go about doing it? I would recommend you take a read of Jake's book. He's got a lot of really good suggestions in there on kind of how to do that. He's got strategies in there on how to invest crypto, on how to. There's lots of different ones out there, how to pick and choose. But again, Jake, to kind of dumb it down for a new investor, how would you have them think about, okay, how do I dip my toe into cryptocurrency?
Yeah, I think the limiting factor is knowledge. And so I would say the amount of Bitcoin, or yeah, start with Bitcoin. The amount of Bitcoin you can own relative to your total portfolio is limited to how many books and podcasts you've
Yeah.
listened to and read. Like, you really have to learn about it before, putting too much in. I think starting with a book and getting, some amount of money, and starting really with just Bitcoin. I would start with Bitcoin, and make a few transactions there and hold that for a while. Definitely would start with that. I would always have, Bitcoin being the primary asset, or that's the one in terms of percentage terms that should be the most of your crypto portfolio. Because it's the most important. It's the base function, and so many others are so much more volatile. Um, and yeah, I think it would just, I really, you have to read a bit about it and start to get your feet wet with the knowledge before I think you can get too hefty into investment.
And what would you go, so beyond Bitcoin, what are some of the other ones that you would at least recommend people take a look at? Because the reality is, what also surprised me really by reading your book is, there's, I don't know if the number is thousands or tens of thousands, but there certainly is a lot of different types of cryptocurrencies that are out there. I was shocked actually that there was that many. I didn't actually realize that there was that many options out there. I thought maybe Bitcoin and a few others, but that's definitely not the case.
Yeah, there's probably 10,000 or 20,000, but really there's probably only a few hundred that are investable, I would say. I think I would look at, three different themes, investment themes. There's this idea of layer one blockchains, right? And Ethereum or Solana would be something like a layer one blockchain. So those I would look at. The second theme would be decentralized finance, or DeFi. And so you could look at some crypto assets that are DeFi tokens, and their whole realm it's about usually lending and borrowing and creating some sort of yield with crypto assets. So that's one area. And then the third theme I would look at is kind of the AI themed, the intersection of AI and blockchain. And there's, probably, a couple dozen that are under that. So I would probably look at themes, right? Layer ones, decentralized finance, and AI themed, and do some research on what are some of the big players there, and starting to think about those different areas.
And even just mechanically speaking, how do you go about and actually purchase a Bitcoin? So I've listened to the podcast, I've read the books, and I say to myself, okay, I'm ready to make my first purchase of a Bitcoin. Um, like how do you actually you do that? Are you going to sign up an account with Coinbase and facilitate a transaction through there? Like, just mechanically speaking, how do you actually go out and purchase a Bitcoin?
Yeah, I think that's probably the easiest way to start. Um, Technically, you could probably buy a Bitcoin through, like, not Venmo, but I think PayPal or Cash App. I think you can buy Bitcoin from, but for the most part, I would get an account on an exchange, something like Coinbase or Kraken, something like that. Get an account. You would move money over from your bank to to your exchange, just like you would with, a brokerage account for securities, for stocks or whatnot. Move money over, and then you would look to buy, and you'd put a limit order just like you would buying stock, and buy Bitcoin. Then as you learn over time, um, you may want to run your own Bitcoin software on a computer or get a like a ledger or ways where you can move the Bitcoin off the exchange and have it under your possession and control. Especially when you get a larger amount, or as we get more and more into the future, I think that'll be an important step. So you want to always be able to move Bitcoin off of an exchange. You may keep it on the exchange half the time, but you always want to have the ability to bring Bitcoin back to your computer or some sort of hardware device. So that's where I would start, and just having a few of those types of transactions and being able to hold that over time, and then you'll start to learn how to use things like a MetaMask, where you might be doing some Ethereum or Solana type transactions. You could be moving Ether or Solana, and they have their own blockchains, and then you can buy any type of Ethereum based token. You could start to learn about decentralized exchanges where you are holding all of your crypto, on your computer here, and then you're connecting with a decentralized exchange and being able to trade, stable coins or Ether for other tokens that you might be looking to purchase. And all of that's being done in a decentralized format instead of a centralized exchange like Coinbase. So there's a lot to learn and grow from, but I think that, just starting with an exchange and buying some initial Bitcoin is probably the best way to go.
And, if you have someone out there who says, well, you know what, I missed the boat, the value of crypto has gone up by so much. It's so high already. It's too late. Maybe give them some perspective, Jake. If you look into the future, you could probably craft an argument that we're just kind of tip of the iceberg stuff, in terms of where, who knows what crypto could be worth or Bitcoin could be worth in years to come. How do you see, things evolving over the next 5, 10, 20 years as it relates to digital currencies?
Yeah, well, we're seeing more and more and bigger buyers of Bitcoin specifically right now. You're seeing institutional buyers starting to buy Bitcoin now that they can get it through ETFs and other regulated structures. But you're also seeing CEOs of Fortune 500 companies starting to want to buy Bitcoin as a purchasing power saver over a long period of time, kind of like the Michael Saylor strategy, MicroStrategy, or it's called Strategy now. Michael Saylor is the CEO and really been the chief advocate of companies having a portion of their treasury in Bitcoin, which is a good value accrual mechanism over long periods of time. And so as we get more and more countries, I think there are 6 countries that have, allow Bitcoin as their, primary, kind of like El Salvador. As we get more countries that may look at that, as we get more institutions buying it, and as we get more CEOs using it as treasury management tool, it's easy to see how something like Bitcoin could go from a $2 trillion to $10 trillion asset, right? It could be as big as gold, which is about a 12 or $14 trillion asset right now. And so I think we're, early to mid stage adoption with Bitcoin. I wouldn't be surprised in, 8 years if it was $1 million per Bitcoin. I wouldn't be surprised if at the end of this cycle, which should be early 2026, if we see something like a 180 or 200K Bitcoin, and I think our cycle will top out at something like at least 200K for Bitcoin. So it's that halving mechanism, and it's the expansion of the global money supply that are the mechanics that drive the price higher. And, the next Bitcoin halving event will happen in 2.5 years from now. And global central banks, they created $5 trillion more in Q1. And that's what's, pushing asset prices right now, is the expansion of global central banks and the expansion of the money supply. So we're continuing to see that more and more this year. And as we see that, we're going to see the price of Bitcoin, I think, go higher.
Yeah. It's interesting. Again, for anybody listening, I would highly recommend you take a read of Jake's book, especially, again, if you really want to learn about crypto, it's a great way to do that. But you don't just learn about crypto, you actually learn about, again, this age of autonomy. Things are changing on a lot of different fronts, AI, robotics, a whole bunch of different things. It's going to be an interesting world in 10 or 20
This is the
years.
first book.
Oh, yeah.
Yeah. You can go see that one.
Yeah. Well, Jake, thank you very much for taking the time. This was a very, very fun conversation. I hope everybody has learned a lot more about crypto. But thanks for taking the time. We really appreciate it.
Yeah, appreciate it. Thanks, Scott.
Yeah, you're welcome.
Take care.
Well, that wraps another episode of CSI Chat, and I really wanted to thank everybody for listening. If you want to keep up to date on CSI Chat, I would encourage everyone to join our CSI Chat LinkedIn group and or follow us on Twitter/X under CSI Chat. With that, I will get you out of here on a high note with some music, and thanks again.
Welcome to CSI Chat, where every topic's fair game. From finance to mysteries, we'll never be the same. Our host an accountant with a knack for a joke. We'll dive into the details and laugh until we choke. CSI Chat, where the numbers beat the fun. We'll explore every subject under the sun. From taxes to true crime, we'll find the hidden clue. With humor and some spreadsheets, we'll see the case through. See the case through. Got a question about investments or a tale of deceit? We'll break it down with laughter and never miss a beat. No need for serious faces, just a sharp wit and a smile. We'll solve it with some humor and go the extra mile. CSI Chat, where the numbers meet the fun. We'll explore every subject under the sun. From taxes to true crime, we'll find the hidden clue. With humor and some spreadsheets, we'll see the case through. See the case through. Got a question about investments or a tale of deceit? We'll break it down with laughter and never miss a beat. No need for serious faces, just a sharp wit and a smile. We'll solve it with some humor and go the extra mile. Got a question about investments or a tale of deceit? We'll break it down with laughter and never miss a beat. No need for serious faces, just a sharp wit and a smile. With humor and some spreadsheets, we'll see the case through. Tune in every week for a mix of win facts with a clever accountant who's got your back. We'll laugh and we'll learn and solve the mystery on CSI Chat, where the topic set us free. Tune in every week for a mix of wit and facts with a clever accountant who's got your back. We'll laugh and we'll learn and solve the mystery on CSI Chat, where the topic set us free. CSI Chat is the podcast you'll adore. With our accountant host, you'll always want more. So grab your headphones and join the fun on CSI Chat, where the mystery's never done.